Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, it's not news that the market sold off a few days ago. The Dow was down over 12 to 1300 points, and the Nasdaq, if you were paying attention, was down around 5%. So a brutal day. Well, it was because it spooked the market, meaning inflation. The inflation was appeared to be heading in the right direction, which is lower, but actually it was up about 0.1% more than the market thought. So big sell-off. Investors are concerned, and in particular, portfolio managers are concerned. We're going to share a little bit about what specifically in a minute, but portfolio managers are concerned. Are things going to get worse? There's a very real possibility that they do. And what I mean by worse is the equity markets. We have seen the more recent low was June 15th. There's a very real possibility we'll get there, at least to test it. Only time will tell. So let's just jump in to the feeling of portfolio managers. They are super bearish with cash holdings the highest since September 11th, 2001, where the average cash balance for global managers is at 6.1%. Now, a couple points here. Now, you may recall back then, meaning in the 2001 period, we had the dot-com bust. It was a 3-year period from 2000 to 2003 where the markets basically sold off in droves. Again, portfolio managers haven't been this bearish since back then, and that was a very rough time frame for the markets. Number two is if the average cash balance right now is a little over 6%, the historical norm for most mutual fund managers and pension fund managers, because by prospectus they have to be for the most part fully invested, the average cash balance tends to be 2 to 3% at most. So they're basically double the cash balance than they have been historically. That is concerning, of course, at least by looking at the portfolio allocation. Will things get worse? Only time will tell, but at least it gives you the mindset by looking at some of these, these data points that portfolio managers are concerned. Will things get worse? Again, only time will tell. Now, you may recall, usually sustained bear markets have 3 down legs. I think we've seen the first 2. The third leg, which is possible, we haven't seen yet, tends to be the worst and the most drastic. I say that because it's a very real possibility. I don't say that to scare you, but hey, that's reality. So a net 60% of investors reported taking lower than normal risk as their biggest concerns are, and again, this is no real surprise to anyone, inflation. As we noted, the inflation number came back a little higher than expected. Central bank hawks, where again the concern is, as the Fed stated, they're going to continue to focus on increasing interest rates. So obviously that's continuing to cause downward pressure, at least concern on the market. And of course, geopolitical issues. We obviously know what's going on overseas, where the most crowded trade was the long dollar position. So you've seen a lot of money really come into the dollar. Now you may wonder, well, why in the world is a lot of money coming into the dollar? Well, the reality is the dollar is still perceived as the safest asset in the world. Now you could wonder why that is. Of course, with the trillions being printed, doesn't that devalue the dollar? Yes, it does, but ultimately it's still perceived, the US dollar that is, as the world's reserve currency and the best source of, let's call it, security when one is parking money. So the US dollar has continued to appreciate, and let's look at what that looks like. Year to date, this is as of most recently, the dollar is up around 13%. If you're at least tracking that by an ETF UUP, and this is according to Yahoo Finance. So again, money has been flowing out of equities and even the bond market, let's call it risk assets, to safe haven assets like the US dollar. Now, will that continue? I mean, the reality is that if things get worse, meaning if the equity market's continuing to get more challenging, there's a real likelihood that, yes, this trend will continue. So we've shared some maybe not so ideal news today, but I want to remind you of one thing, and you know this, but sometimes, when you see the negative headlines, you forget the reality of the long-term perspective. The growth, this is an example, since 1926, if you put $1,000 in the S&P 500 index, over that period of time, again, during the Great Depression, the world wars that we've had, the oil crises, of course, Black Monday, that was a terrible day for the markets in 87, the tech bubble, which we just talked about, even COVID, as you know, from February to March 2020, the market sold off around 33%. Over longer periods of time, the markets obviously do well. Now, this does not mean that things won't get more challenging, as I noted. This does not mean that the market will not continue to sell off. But again, sometimes by taking a step back, looking at the bigger picture, you could feel more positive about where we're at. At the end of the day, as they say, we'll get through this. This too shall pass. To that end, if you would like some more clarity, and would like to get a second opinion, you're certainly welcome to reach out to us. This is our website. You can click on upper right-hand tab of this website, the Contact Us tab. Fill out the information, and one of our advisors will get to you and chat with you and hopefully provide you a little more clarity. Thanks again for watching. Bye-bye.